investors?
Yeah, so the Russian invasion of Ukraine is, let me preface this by saying, in my opinion, it is mostly a non-event for the markets, but there is a risk that it becomes very, very, very bad.
Okay.
Because the thing here is that if Russia were to invade the Ukraine at any other point in time besides 2022, it would almost assuredly be a non-event for the markets. Maybe you get a 2, 3, 4, 5% pullback in equities, followed by a sharp rebound. However, in 2022, inflation is red hot, and the US Federal Reserve has made it their mission to combat that inflation. What the Russian invasion of Ukraine does is exacerbate, perhaps temporarily, but exacerbates the current inflation situation.
Mm-hmm.
Because Russia is a massive exporter of oil and natural gas.
Mm-hmm.
They're a massive exporter of wheat, and they're a massive exporter of metals. When Russia invades Ukraine, the rest of the world throws sanctions on all of that supply, on all of those exports.
And what does that mean to throw sanctions onto?
Well, it's going to make them prohibitively expensive and or inaccessible in
Mm-hmm.
most situations. So in this situation, it's going to make a lot of it inaccessible. So basically, you're taking a lot of the supply of those three major commodities and removing them from the market and or elevating their prices in the market.
Mm-hmm.
Now, what that does is it creates more commodity inflation. So you're seeing oil prices jump, you're seeing natural gas prices jump, you're seeing wheat prices jump, you're seeing metal prices jump. So you're seeing those jumps happen.
So how much of a jump are we looking at with these commodities?
Well, so it all depends on the size of the sanctions and the duration of the sanctions,
Mm-hmm.
right? If the first round of sanctions that have come in appear to be less severe than what a lot of people had feared, and that's actually providing some support for the market. But if Russia's military actions grow bolder and bolder and bolder, the sanctions will grow bigger and bigger and bigger, and the duration of the sanctions will last longer. So if these sanctions do get really large, if they do last for a long time, they're going to cause meaningful jumps in commodity prices.
Mm-hmm.
And those meaningful jumps, we're talking probably 10, 20, 30% lifts in commodity prices, in wheat prices, and metal prices, and oil, natural gas prices. That will turn inflation, which is red hot, but was starting to come down a little bit because
Mm-hmm.
of supply chain improvements. It will reaccelerate inflation. Reaccelerating inflation could get the Fed to think, hey, we need to act more quickly. And all of a sudden, what may be 3 or 4 rate hikes in 2022 turns into 7, 8, 9, or 10. And that is a situation where the US economy will significantly struggle and the US stock market will significantly struggle. Because remember, against the backdrop of all of this, the US economy is slowing.
Mm-hmm.
And that was already happening before this conflict. This conflict is not going to be a positive development for the US economy. So you're going to get a slowing economy, more inflation, more rate hikes. That's a recipe for a disaster in 2022 for stocks and for the US economy.
Now, I know that when you make these kinds of analysis, a lot of the times you like to look to the past. To you again, when we talk about bubbles, you always kind of go back to the .com bubbles and to kind of give a context for the explanations and the reasons why you are going into the things that you're going into. Do we have any kind of historical precedent for this type of conflict with the type of economy that we see and the type of market that we see right now? All these, like this convergence point of things coming together?
So we've talked about it before that there have been dozens upon dozens of geopolitical conflicts over the past 50, 60 years. Normally they are non-events. They're run-of-the-mill sell-offs, average drawdown about 4%. You take out attacks on home soil. You take out 9/11. You take out Pearl Harbor. You're talking about a 3% pullback over 20 days. Very tiny sell-offs normally as a result of these geopolitical events. But what you have right now is more than just a geopolitical event. You have a geopolitical event converging on other risks, which are red hot inflation and a hawkish Fed. That creates a situation that's similar to the 1970s. The 1970s was an era of lost economic productivity because you had red hot inflation as a result of surging oil prices and a Fed that was doing everything it could to fight that inflation by hiking rates and killing the economy. So you had a decade of stagflation, a decade of lost economic productivity and growth, and a decade of terrible stock market returns. That is the bear case for what happens here.
Mhm.
That the Russia-Ukraine conflict is the catalyst for what sparks a decade of lost growth in the 2020s. That is the bear case, long-term bear case, what happens here. Now, the reason we don't think that will happen, because remember at the top of this call, I said, hey, I think it's a non-event, but there is a risk it could turn into something really
Yeah.
bad. We just talked about the risk of it turning into something really bad, but our base case remains that something really bad will not materialize. And that's because we are in a very globalized economy where every country is dependent on every country. Every economy is dependent on every economy. Therefore, the sanctions that we put on Russia during this conflict
Mhm.
will not be significantly large, will not last very long, very much like the US-China trade war in 2018, right? We had the US-China trade war. We were trying to really put tariffs on them, really make things, awful for their economy. But in turn, we were kind of shooting ourselves in the foot, and our own economy was slowing.
Mhm.
So what happened is we pulled back on the tariffs. The Fed actually stopped hiking rates and went into a rate cut cycle because the economy was slowing domestically. So I think that what you get here is that if we get to a point where these sanctions do start to really hurt real economic demand, real consumer demand, they do start to meaningfully exacerbate the inflation situation.
Mhm.
The governments of the world, the central banks of the world will pivot. The governments will
Okay.
pivot to reducing sanctions. They will pivot to working something out with Russia, getting a diplomatic resolution here. The central banks will pivot to not hiking rates so aggressively in the face of a slowing economy to create a stagflation situation like the 1970s. Basically, if you have faith in the powers that be, governments and central banks, to support their own economies,
Mhm.
which you should, then this event will most likely result in end up being a non-event for the markets. It's going to create near-term turbulence, a great buying opportunity, preceded by what we believe will be a second half rally in stock. So our confidence in the stock market right now, in this sell-off not turning into something nastier,
Mhm.
is confidence in the US Federal Reserve, the US government, the ECB, the
Mhm.
Bank of England to figure out that, hey, we need to adjust policy to the current macroeconomic geopolitical climate and not be so blind to fight inflation.
Mhm.
History says they will do that. We believe they will do that. The data says they're going to do that. So that's why we're taking the sell off in stride and we're continuing to accumulate into our favorite positions
Mhm.
and believe that puts us in a great position to benefit from a